Market structure is one of the most powerful concepts in trading, yet most explanations make it feel way too complex. The truth is, it's actually simple if you focus on what really matters. In this video, I'm going to remove all the confusion and share 8 key concepts that every trader needs to master market structure with confidence. But first, let's start with the basics. There are only 3 types of market structure you really need to know: uptrend, downtrend, and range. Let's keep it simple and break each one down. First, the uptrend. This is when price keeps moving higher. You'll see higher highs and higher lows. That just means buyers are in control. In this kind of market, the smart move is to look for buying opportunities when price pulls back. Second, the downtrend. Same concept, but in the other direction. Price is making lower highs and lower lows, which shows sellers are in charge. So instead of buying, you're looking for chances to sell and follow the trend. Third, the range. Price isn't really going up or down, it's just moving sideways between support and resistance. Buyers and sellers are basically balanced. This is where a lot of traders get stuck or take losses, because there's no clear direction to follow. Now here's the key point. Market structure is just the pattern of how price moves, whether it's making higher highs or lower lows. These moves reflect what people are feeling, things like fear, greed, and hesitation. When you understand these patterns, you'll have a better sense of what the market is doing, and that helps you trade with the trend instead of fighting against it. Now let's get into another important concept. Look at this strong move right here. Price is moving up fast, with big green candles, almost no wicks, and each candle closes higher than the one before it. This kind of move is called an impulse. It shows buyers are fully in control. And most important, price breaks above the previous high. That break tells us the trend is now going up. Now, here's what usually happens after a strong move like this. After that big push, price starts to slow down. You'll see smaller candles, some red ones, and maybe price moves sideways a little. The candles don't look as clean anymore. There are wicks, and price isn't moving as far with each candle. That's the pullback. It's just the market taking a small break before the next move. Here's the important part. Price doesn't fall below the last low. That demand zone is still holding. The market is keeping its structure. Then suddenly, price finds support and moves up again, making a new high. That's a clear sign the uptrend is still strong. Smart traders wait for this pullback to buy, not after the big move has already happened. Here's a common problem traders face. They look at a chart, and they're not sure if price is trending up, dropping, or just moving sideways. They try to mark zones or draw trend lines, but it still feels unclear. So how do you fix that? It starts with understanding swing highs and swing lows, the key points where price changes direction. A swing high forms when price moves up, then turns and starts falling. A swing low forms when price moves down, then turns and starts rising. For example, if price pushes up and then pulls back, that high point is a swing high. If price drops and then bounces back up, that low point is a swing low. Why does this matter? Because if price breaks above a swing high, it often signals that buyers are in control and the market could go higher. If it breaks below a swing low, it usually means sellers are taking over and the market may move lower. Swing highs and lows are like signposts on the chart. They help you see where price is turning and give you a clearer view of the trend. It's easy to spot a swing high or a swing low, but the real question is, will the trend continue or is it about to reverse? That's where 2 simple tools come in: break of structure and change of character. Let's start with break of structure. Imagine the market is in an uptrend. Price is making higher highs and higher lows. Then price pulls back a little and pushes higher again, breaking the last high. That's a break of structure. It tells you the uptrend is still strong. You can draw a line across the last high to mark it. Once price breaks and closes above that line, that's your confirmation. It means the market is still bullish. Now let's talk about change of character. This one tells a different story. Let's say the market was in an uptrend, but this time, price doesn't break the last high. Instead, it forms a lower high and then breaks below the last low. That's your change of character. It's the first clue that the trend might be changing. The uptrend could be over. The market might be turning bearish. So when you see a change of character, it's time to pay attention. You might stop looking for buys and start watching for possible sell setups. Here's the simple way to remember it. Learning how to spot these on the chart helps you stay one step ahead. You'll know when to stay with the trend and when it might be time to change your plan. Strong lows, weak highs. Let's spot them on the chart. First, notice how the market is in a clear uptrend. You can see price making higher highs and higher lows. Every time price pushes up, it pulls back a little, then pushes even higher. That's a strong bullish structure. Now, focus on these pullback points right here. These are what we call strong lows. See how price dips into these areas, but buyers step in and push it right back up? These strong lows act like support. The market respects them, and they help keep the uptrend alive. On the flip side, check out these highs. These are what we call weak highs. Price struggles around them for a bit, but notice how they don't hold for long? The trend eventually breaks right through. In a strong uptrend, weak highs usually get taken out as price pushes to new higher highs. Let's talk about something really important: how to spot a confirmed swing low, valid strong points, and why it matters. Alright, let's walk through this together. Imagine we're looking at a real chart and price is trending up. You see how it moves higher, then pulls back a little? That's normal. Price doesn't move in a straight line. It moves in waves. Now, focus on the pullback. The lowest point of that move down is called a swing low, but it's not confirmed yet. It only becomes a confirmed swing low once price pushes higher and breaks the previous high. What we call a break of structure. You might spot small dips during the pullback, little lows here and there. Ignore them. They're just noise. The real swing low is the lowest point price bounces from before making the new high. So, how do you mark it? Start by finding the last swing high, or a weak high just before the break of structure. Draw a horizontal zone from that area. Then, inside that zone, identify the lowest point where price stopped falling and reversed upward. That's your strong low, and your confirmed swing low. Why is this level so important? Because it shows where buyers stepped in with strength. If price pulls back and reacts at that level again, it's a strong sign the uptrend is still healthy. But if price breaks below it, the trend might be shifting. Now, after a break of structure, watch for a pullback. That pullback often tests the strong low. If buyers defend it, that's a high probability place to look for a buy. You're aligning with the trend and trading from a strong level. And in a downtrend, same idea, just flipped. Price trends down, makes a low, pulls back, then breaks a previous low. Mark that broken low. When price pulls back to it and sellers step in, you have a clean opportunity to sell with the trend. Now let's jump into another powerful concept: how to find a valid pullback. To do this, we use the Fibonacci tool. Alright, let's jump onto the chart and find a valid pullback together. So, as you can see here, price has been moving upwards. Now, if the market was about to turn bullish, we would expect to see price making higher highs and higher lows. But let's take a closer look at what actually happens next. After some time, we notice price begins to pull back a little. It's just taking a pause in the market. So, the question is this a valid pullback? Let's find out. Grab your Fibonacci tool and draw it from the recent low to the high, where price pulled back. Now that we've done this, we can see that price pulled back to the 38.2% level, and even dipped slightly into the 50% level. This confirms that yes, this is a valid pullback. When price retraces to at least the 38.2% level, we consider that a healthy pullback. Now, after spotting a valid pullback, there's one more thing we always do. We mark the weak high and watch to see if price breaks above it. If price breaks above that weak high, it signals continuation, and that's exactly what happened here. Price broke to the upside, giving us a break of structure. After this break of structure, we can confirm that the recent low is now a strong low, which is important for the trend. Let's keep going. Price moves down a little. Now, let's check if this is another valid pullback. Again, draw your Fibonacci from the previous strong low to the new high. What do we see? Price didn't reach the 38.2% level. It stayed above it. So, this is not a valid pullback. We can mark this area as noise or a minor continuation zone, but it's not a proper retracement. After this, price pushes higher again. Once more, we draw the Fibonacci from the new strong low to the high. And this time, price pulls back to the 38.2% level nicely. This is a valid pullback. We mark the recent weak high, and later, price breaks above it again, giving us another break of structure and confirming the new strong low. Alright, moving forward, we draw Fibonacci again from the new strong low to the high. Price pulls back again, and yes, it touches the 38.2% level. So, once again, this is a valid pullback. We mark the weak high, but now, something interesting happens. Instead of breaking higher, price reverses and moves down, breaking the strong low. This gives us a change of character. After a change of character, the trend might be shifting, so the previous weak high becomes the new strong high. Let's keep tracking. Price pulls back slightly. Draw your Fibonacci from the new strong high to the low of the pullback. This time though, price doesn't touch the 38.2% level. So, again, it's not a valid pullback. It's just noise or minor continuation. Now, after some time, price moves lower. We draw Fibonacci from the strong high to the new low. Price pulls back slightly upwards, and this time, it touches the 38.2% level, and even dips into the 50%. This is a valid pullback. We can mark the new week low. After that, price continues to break lower, giving us a new break of structure and confirming the strong high. One last step, after the new break of structure, price pulls back again. Draw Fibonacci from the strong high to the new low. Price touches the 38.2% level once again, so this is another valid pullback. We mark the week high, and later, price moves impulsively downward again, giving us another break of structure and confirming the new strong low. Let's talk about one of the simplest but most powerful trading rules. Buy low, sell high. It sounds basic, but once you connect it to how price actually moves, it becomes a game-changing strategy. Let's start with an uptrend. Picture this. Price is making higher highs and higher lows. A strong, healthy uptrend. After a big push-up, price usually pulls back. Now, this is where we want to step in and look for buys, but not just anywhere. We want to buy when price is cheaper, when it's giving us a discount. Here's how we find it. Grab your Fibonacci tool. Measure from the lowest point to the highest point of the move. Now watch where price pulls back. If it pulls back to around 50% or deeper, that's what we call the discount zone. This is where you're getting a better deal and giving yourself a much better risk to reward on the trade. Alright, now let's flip it and talk about a downtrend. Picture price making lower highs and lower lows, just a steady move down. After a big drop, price usually pulls back up a bit, but this time, we're not looking to buy. We're looking to sell high. Same idea. Grab your Fibonacci tool, but now measure from the highest point down to the lowest point. If price pulls back to 50% or higher, that's your premium zone, the sweet spot to look for sells at a better price. So, to keep it simple, in an uptrend, you want to buy in the discount zone. In a downtrend, you want to sell in the premium zone. Once you start trading this way, combining market structure with premium and discount levels, your setups will make way more sense, and you'll feel a lot more confident taking your trades. Alright guys, now let's put everything together. This is where it all makes sense. Start by picking any high point. I'm starting from here. You can see price starts moving down, and we expect the market to form lower highs and lower lows, showing us a bearish trend. After a while, price pulls back. So now grab your Fibonacci tool and draw it from the high to the low. Here, price retraces to the 38.2% level and even taps the 50%. That tells us this is a valid pullback. So we go ahead and mark the week low. Since the market is still pushing down, we expect bearish continuation, and eventually, price breaks lower, giving us a break of structure. That confirms the downtrend. Now, we need to mark the strong high in this move. To do that, draw a horizontal zone from the week low up to the breakpoint. Extend that zone upward and find the highest point inside it. That's your strong high. Then price pulls back again. So let's check if it's valid. Use your Fibonacci tool from the strong high to the new low. You'll see price comes back to the 38.2% level and even hits the 50%. That's another valid pullback. We mark the new week low, but here's where something shifts. Instead of continuing down, price breaks above the previous strong high. That gives us a change of character. Because of that break, the week low now becomes a strong low. The trend has flipped. We've moved from bearish to bullish. After the change of character, price pulls back again. Use the Fibonacci tool from the new strong low to the new high. Once again, price retraces to the 38.2%, confirming a valid pullback. So we mark the week high. Price pushes up, breaks the week high, and gives us a break of structure. As always, we mark the strong low, the lowest point before that break. Now price pulls back again. Use your fib tool from that strong low to the high. But this time, price doesn't even touch the 38.2% level. That tells us it's not a valid pullback, just a continuation move. After that, price keeps moving up, then pulls back again. And this time, it does reach the 38.2% level, maybe even a bit deeper. So now, it is a valid pullback. We mark the week high. Price then pushes higher and breaks that week high, giving us another break of structure. So again, we mark the next strong low, the last low before the break. Price pulls back again. Use your Fibonacci tool from the strong low to the new high. This time, price touches both the 38.2% and 50% levels, so it's a valid pullback. We mark the week high. Now, here's the twist. Price was moving up, but then it breaks below the strong low. That's a clear change of character, which means the market has flipped back to bearish. Because of that, the last week high now becomes the strong high. To mark it, draw a horizontal zone from the strong low to the break, extend it upward, and pick the highest point in that area. That's your new strong high. Price drops sharply. After some time, it pulls back again. So, grab your Fibonacci tool and draw from the strong high to the low. Price comes up to the 38.2% level. That's a valid pullback. We mark the week low. Then, price breaks below that week low. That's a break of structure. So, we mark the new strong high, which is the highest point before the break. Next, price pulls back slightly. Use your Fibonacci tool again from the strong high to that small pullback. This time, price doesn't reach the 38.2% or 50%. so it's not a valid pullback. It's just a continuation move, and price keeps falling. Eventually, price pulls back deeper. Use the Fibonacci tool again from the same strong high. Now, price hits both the 38.2% and 50% levels, so yes, it's a valid pullback. We mark the week low. Now, why is this important? In a downtrend, we expect weak lows to break. That's the logic behind market structure. In an uptrend, it's the weak highs. Later, price breaks lower again, giving us a clean break of structure. So, we mark the new strong high, which is the highest point before the break. And that's the process. Follow these steps consistently, and you'll stay in sync with the market. A lot of traders ask me, which time frame should I use? Here's the answer. It's not about the time frame, it's about the structure. Whether you're on a 4-hour, daily, 15-minute, or even a 1-minute chart, the way you read market structure stays the same. The key is consistency.